Welcome back to our series on accounting journal entries. Today we're going to dive into the journal entry to record sale of inventory and discuss how the journal entry impacts the income statement and balance sheet. To make it more relatable, let's walk through an example together. Our business transaction for today is as follows. On November 1st, Company ABC sold merchandise at a price of $2,000 to a customer. The customer paid $2,000 in cash at the time of the sale. The merchandise had original cost Company ABC $600. To record this transaction, we'll need to create a journal entry. Journal entries are used to capture and document the financial effects of transactions on a company's accounts. Let's go through the journal entry step by step. Since the customer paid $2,000 in cash, we'll need to debit the cash account for that amount. This debit entry represents an increase in the company's cash resources. Now let's move on to the other side of the journal entry. Since Company ABC sold merchandise for $2,000, we'll credit the sales revenue account for that amount. This credit entry represents an increase in revenue, as it reflects the income generated from the sale. Additionally, we need to account for the cost of the merchandise sold. The original cost of the merchandise to Company ABC was $600. To record this, we'll debit the cost of goods sold, COGS account, which is an expense account, for $600. This entry reflects the cost of the merchandise that was sold during the transaction. Finally, we need to credit the inventory account for $600. This credit entry represents a decrease in the value of the inventory, as it reflects the merchandise that has been sold. Great! We've completed the journal entry. Now, let's discuss the impact of this entry on both the balance sheet and income statement. The balance sheet is a snapshot of a company's financial position at a specific point in time. The journal entry we just made affects three key accounts on the balance sheet: cash, inventory, and equity. By debiting the cash account for $2,000, we're increasing the cash balance. The credit entry to inventory for $600 reflects a decrease in the value of the inventory. Additionally, the credit to sales revenue increases the equity section of the balance sheet. Now, let's move on to the income statement. The income statement summarizes a company's revenues, expenses, gains, and losses over a specific period. Our journal entry impacts two accounts on the income statement: sales revenue and cost of goods sold. The credit entry of $2,000 to sales revenue increases the total revenue reported on the income statement. However, the debit entry of $600 to COGS represents the cost of the merchandise sold, reducing the company's net income. Overall, the net income increases by $1,400, assuming there are no other transactions. And that's it for now. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated with our future accounting lessons. Thank you for watching and see you in the next video.